All right, it's 9 o'clock, we've got a quorum.
We have a quorum, we just don't have.
I'm going to go ahead and call the meeting to order. Let's see here, let's do roll call. John Fisher, member.
David Rader, member.
Pat Keough, member.
Harvey Lewis, member.
Greg Williams, staff.
William Johnston, staff.
Brendan Babrica, Anco Consulting.
Yes.
Mary Caskey, Brown Advisory.
Doug Williams, Brown Advisory.
Very good. All right, we have adoption of our agenda for us.
Move the adoption.
Do I have a second?
Second.
All in favor, please say aye. Aye, we have our agenda. We have the minutes from our last meeting.
Move the approval.
Second.
All in favor, please say aye. Aye. All right. Let's see, we have Twin Capital Management.
They're not here.
We'll
so-
go ahead. Let's put Brown Advisory first up on the docket.
Okay, lucky us. Good morning, everybody.
Good morning.
Thank you for having us here today to give you an update. I've been here a number of times before, Mary Caskey, and then this is my colleague Doug Williams, who's been with us virtually last year, but now he's here in person. And Doug is part of the large cap growth team at Brown Advisory. He's the investment specialist. So Doug works very closely with Ken Stuzen. You may remember some years ago, my colleague Kevin Austin would come to these meetings with me, and Kevin left the firm a couple of years ago, and Doug has stepped into the role. And this is Doug's sole devotion at Brown Advisory, to be focused on the large cap growth strategy that Ken Stuzen and team run for us and have managed this portfolio for you. So let's see, I think normally we take total of half an hour. Is that too much time? Talk to us about your agenda.
It's a half hour with questions. We're a
Half hour.
fairly interactive group, so
Yeah.
it's great with you. If we have, during the presentation, we can stop and answer questions, but that should be fine.
Okay, very good. I have just one updated page, which I will start to send around. This is a corrected page 11 in the book that you should have. So thanks to Doug for catching the problem with the numbers. Let me pass this down. Do you have the corrected page 11?
Yeah, I do.
Okay, good. Okay. Great, so let me give you a quick organizational update, and then Doug can dive right in with the update on the performance. We've run the numbers through June 30th, so we'll do that. Thank you very much for being a continued client, for your partnership. I enjoyed seeing William, seeing you at the Florida conference, and I got to meet with some ANCO consultants there as well. Always good to stay in touch. We appreciate your partnership over these number of years. We know that it's been a challenging time for relative performance, although pretty lights out for absolute performance. The market, as you know, has been really narrow, and we're going to talk about that and the difficulty for us, even as a concentrated manager, of outperforming in this market that's just driven by 7 or 8 names sometimes. Brown Advisory continues to grow steadily. We are still privately owned, focused on investment management 100%, growing a little bit globally our footprint. So we've got now a Tokyo office. That's new in the last year. One person is there, just sort of expanding our footprint overseas. But mainly our business is here in the U.S. And if you look at page 4, and these are our assets under management on the institutional side of the business. So about $60 billion in institutional assets under management. The large cap growth strategy, which you all are invested in, makes up about $12 billion of that. And then on the right side, you see sort of the breakdown of the different investment vehicles that we have within the large cap growth strategy assets. And obviously your section is the institutional section, run as a separate account, but we also have commingled vehicles, mutual funds, and UCITS. So the assets under management have been fairly steady. There have been some outflows, market increases, some inflows, but probably a little more outflows than inflows. There's been a long-term trend of a move towards passive, and I know you all have discussed that and made decisions over time in regards to that. We still obviously firmly believe in active management and the value that can be provided through active management over time. And I think this is a really interesting inflection point in the market, with it being so narrow and with the anticipation that it will eventually broaden out and will be a better environment for our style of stock picking that's more fundamentally oriented, bottom-up driven, rather than momentum trend driven. Moving on to the next page, page 5, the equity research team page. Let's see, I think there is maybe one person to mention who's joined in the last year. Looking for the name on here. Would that be Jake Lubell? Yes, Jake Lubell, under the central column under industrials. He joined us within the last year. But it is a steady team. They work together very closely. There's a number of analysts within this larger group that work much more closely with Ken and Doug on large cap growth strategy. We can talk more about that as well. I'm sure Doug, when he talks about some of the stocks, might mention some of these names as the analysts who cover them and who Ken works with most closely.
And Mary, maybe just quickly to highlight on this page, if you look on the right side of this page, you'll see a column called Investigative. That team is made up of 4 individuals, and I think it's a little unique in this space where these are folks that are not, they don't cover specific companies, they're project-based, so a portfolio manager or a fundamental analyst can come to them with a specific project. And I'll give you an example of a recent one for large cap growth. One of our holdings is Atlassian. Atlassian is a collaboration tool for software developers, and there was a lot of chatter earlier this year that with the rise and influence of AI, that might limit the number of software developers that are needed and that software developers were getting fired. So this team conducted a project where they reached out to about 15 Atlassian customers. They reached out to HR and headhunter people on the West Coast. And really the conclusion was that no one is firing software developers, and that from an AI perspective, it can actually take sort of a junior level software developer and make them a mid-level software developer, which long run will be good for sort of driving the number of seats and the power users within a company like Atlassian.
So any questions on the organization or the team before we move on?
No.
Great. All right, the next page it summarizes the strategy profile, and this page, not a word has changed. So you know it's a concentrated portfolio, as I said, fundamentally oriented, bottom-up driven, and we are valuation conscious in the stock selection, long-term oriented, fairly low turnover, high active share. Looking for a certain level of growth, though. I think that's one of the key points in reminding you about our investment philosophy. Ken Stusen and team are looking for companies that can grow at earnings per share at 14% or better over a full market cycle. So that's not looking at the past numbers and doing it quantitatively. That's doing fundamental analysis and saying which companies are capable of being the highest, fastest growing quality companies within this universe that we're looking at, and then narrowing down the universe to that. So we have sort of a growth hurdle, and I think Doug will certainly mention that when he talks about, for example, why we don't own Apple, which has been a big driver in the markets. So moving on, let's look at performance, and we've got attribution and discussions in here on what added value and detracted value over the year-to-date period through June 30, 2023, and also looking at all of last year, being conscious that we only spoke with you in August of last year. So let's start with what's happened year-to-date. The portfolio is up about 23% net of fees year-to-date through June 30th, trailing the Russell 1000 Growth Index. The calendar year record is shown here, a long record here with some pretty good, strong numbers. But let me turn it over to Doug to talk about what's happened year to date, and then if we want to, we can go back to what happened in 2022.
Yeah, and we'll jump to page 9 here that shows sort of high-level attribution by sector. And to Mary's point, usually if this portfolio was up over 24% through the first 6 months of the year, we'd be very pleased. And we are from an absolute return perspective, but we are trailing the benchmark. And there, apologies for jumping around here, but if we go to slide 13, there's really 2 main reasons why we're trailing the Russell 1000 Growth, and a lot of it has to do with sort of the underlying concentration in the index. The Russell 1000 Growth is off to its best start to a calendar year in its history, to provide some perspective on that. And then slide 13, I think, is really interesting. The top 7 companies in the Russell 1000 Growth year to date have accounted for more than 70% of the benchmark's return. So the benchmark, the Russell 1000 growth is up about 28%. 20 percentage points of that has come from those top 7 companies by market cap. The remaining 430 so stocks in the benchmark are up about 8%. So there has been, you've sort of been put in the penalty box year to date if you do look different than the benchmark. And as everyone knows, this is a relatively high tracking error, high active share strategy. So let's jump back to the attribution again, sorry, on page 9, sorry for jumping around here. But I'll start with positioning. I mean, we remain underweight in information technology at 32% versus 41% in the Russell 1000 growth. If you double click within tech, much of that underweight is from not owning Apple. In hardware, Apple is about 13% of our benchmark. We've owned Apple in the past. We bought it in 2008 and owned it for about a decade, made a lot of money in it, but the law of large numbers was catching up with Apple, and it was no longer going to meet that 14% growth criteria that we have. Happy to talk about Apple as much as everyone would like, but it's about a 6 or 7% consensus grower. It's trading at 32, 33 times, so a PEG of more than 4, which is incredibly expensive. But as you all know, I mean, Ken Stuzen has been running this strategy for over a quarter of a century, and he is very consistent in the application of the process, regardless of what the underlying benchmark looks like. The underweight has been a drag on relative performance this year. Our average stock within tech is up about 45%, lagging about the benchmark, which the average tech stock is up almost 50%. If you were to move this report forward through the end of July, I think it's important to note that stock selection within IT is positive. On the flip side, we do have an overweight to healthcare, a pretty significant overweight. A lot of that is in medical technology. We like a lot of the business models within that space. Stock selection has been very strong in that sector, but again, the healthcare names have not been able to keep up with some of the high-flying tech stocks in this environment. But again, from a positioning perspective, very comfortable with where we are. The other comment on sort of our underweight in tech is our underweight to Microsoft. Microsoft is a name that we really like, and we like the long-term opportunity there. It's one of the largest positions in the portfolio, but we do have an underweight. We will max out any position size in this portfolio at 5%. We think that that is a really important risk mitigation tool. Risk to us is not active share or tracking error, it is permanent impairment of capital. And our view is that if you have one position that is 10 or 12% of your portfolio, a lot of your performance becomes driven by that one individual name instead of the combination of all of your high conviction ideas. So I did want to highlight that from sort of one of the rules of engagement that we have in this portfolio.
I'm just curious with Microsoft, so it's your view that that meets the 14% runway?
Yes, it does. Yep. And a lot of that comes from their cloud business. I mean, they're doing really well in Office as well, but a lot of that growth is coming from their cloud business.
And I think it's interesting, if you roll back 5 years, we weren't thinking about Microsoft that way.
Yeah, I mean, Microsoft is a name that we owned, we probably bought in 2003, owned it for maybe a decade, sold it as Office started to slow and PC sales started to slow. And then again, it's a company that the team continued to follow, and then it did start meeting our growth criteria as they rolled out that cloud business. Let me stop to see if there are any questions on any of the positioning before we jump into some of the individual drivers. All right, so we'll jump into page 10. The names at the top of this page certainly have some similarities. A lot of these companies have reported really solid fundamental results this year, but also there's been a lot of excitement and a little bit of boost in these stocks because of sort of the broad excitement around generative AI. And NVIDIA is the poster child for this. You can see it up 190% through the first 6 months of the year. They reported last night. They were up 8% or so after earnings last night. So, I mean, the stock is probably up 230% year to date. It's a great fundamental company. The reason that we own NVIDIA and we bought it in the first quarter of last year is that they have a technological advantage in the GPU space. They have a supply chain advantage, and they will continue to benefit as enterprises transition to the cloud. That is our long-term thesis around NVIDIA, but again, we're happy to see it up 220% year to date through the most recent time, and this has become a source of capital for us. It has breached our 5% rule, and we've reallocated some of that capital elsewhere.
It might be interesting to expand on that 5% rule as a connection to performance, generally speaking, in the index. I know you're probably going to get to that, but I know we're going to be short on time. So.
Yeah, no, I mean, we've had some clients ask, well, is that 5% rule been additive to performance over the long time? And I've talked about how it's a really important risk mitigation tool, and that is the primary reason that we have it in place. But it is something that we look closely, and it's important to highlight there are two parts of that trade. You're trimming back, obviously, on a name that's breached 5%. Hypothetically, that's probably gotten closer to our upside price target. And you're reallocating to that capital to other names in the portfolio where that upside to downside is hopefully skewed a little bit more in our favor. So ServiceNow, Intuitive Surgical, NVIDIA are all three names that we've trimmed back this year because they've breached our 5%
Have
limit.
you ever back tested it?
Yes, we
Because
have.
in one way, you're selling your winners.
You are selling your winners. We have taken a look at some of the historical trades. It hasn't been a huge number of trades. Probably in the last 5 years, we've probably made 7 or 8 trims below 5%. Obviously, this market environment, we've seen very strong absolute returns. But we partner with a behavioral coach called Essentia, and they take a look at a lot of this data for us. They try and look at Ken's biases and understand sort of the tools and construction that he does in this portfolio, and that is one of the things that has been additive to relative performance as you look over the last 10 years or so. ServiceNow is a really pretty large position for us. They're really a digital transformation partner, so they come into to an enterprise, they take a look at tasks that are being conducted manually across different teams, and they find out ways to automate those. It's a great way for an enterprise to long-term save a lot of money. And you might ask, well, why is this such a big position in the portfolio? There are a couple of really interesting sort of business characteristics that make this an exceptional company. More than 90% of the revenues are subscription-based. They have 99% renewal rates. More than 80% of their new business comes from existing customers. All three of those things are pretty compelling and speaks to the product that they have. And quickly on AI, there was some chatter around how ServiceNow would be impacted by the rollout of AI. They've made it very clear to investors in the street that they will be launching a product in the back half of this year that will integrate AI into their underlying tool set. And then let me stop there. I mean, Microsoft and Alphabet, a lot of a similar story where they've clearly been sort of first movers into the AI space, and their stocks have benefited from that. But I do want to leave time to talk about some of the bottom drivers as well. All right, so we'll jump into Estee Lauder. They're the cosmetics and beauty company. The stock has certainly been under some pressure this year for one primary reason. There has been a slower than expected recovery in Chinese travel. A lot of the growth from Estee Lauder, a lot of their growth comes out of China. And while when you look at Chinese travel, you have seen a rebound close to pre-COVID levels of people traveling from one Chinese city to another Chinese city. But there has not been the same sort of rebound to pre-COVID levels of people traveling inside and outside of China, cross-border travel, or to Hainan Island. And a lot of, actually, one of Estee's largest customers is China duty-free. So there has been sort of this buildup in inventory because that rebound has not happened, and that has impacted the stock as they clear out some of that inventory. We've actually asked the CEO last week, well, do you regret sending as much inventory to China duty-free as you did? I think it was somewhere between $750 million to $1 billion of inventory was sent to their largest local customer who has boots on the ground, who expected this rebound to happen as well. And their comment was, no, not at all. There's no expiration on these products. And the last thing you want to have happen is this rebound in cross-border travel and your product not be there. That is how you lose share. So that they don't really have any regrets there. The other thing that gives us comfort in Estee Lauder when thinking about China is that they have continued to gain share in mainland China. So it is not a competitive issue. It's really just sort of as we move into a more normal environment from a cross-border Chinese travel perspective. SBA Communications is one of the 3 publicly traded tower companies here in the U.S. They continue to benefit as AT&T, T-Mobile, and Verizon continue to spend and invest in the build-out of 5G. The reason that the stock is down is specifically because of higher interest rates. This company is classified as a REIT. They actually lease their towers to the T-Mobile, Verizons of the world. So with that comes great visibility into their underlying revenue streams. These are typically multi-year contracts. They know exactly the escalator clauses that are built into those contracts. So with that visibility, they lever up. They don't have a huge amount of leverage, but this is sort of the highest leveraged name company in the portfolio today. We expect as soon as we start to see sort of a potential pause in rates that this stock and the other 2 tower companies alongside of it will perform quite well, and we continue to like the long-term fundamental story for SBA. Maybe I'll jump down to Thermo Fisher because I think it's an interesting. They're a healthcare company. They're really a picks and shovels provider to all things life sciences and within research labs. Their tools and technologies are essentially used in every lab across the globe. And this week, even Novo Nordisk hired Thermo Fisher to be one of the 2 companies in the U.S. to fill the injectables for their Wegovy drug, their GLP-1 drug. So again, they just have this great opportunity to play sort of the rising tide when we think about sort of lab research across the globe. The stock is down primarily because of a slowdown in funding within emerging biotech. A lot of the banks on the West Coast, like a Silicon Valley Bank, were providing funding to some of the smaller biotechs. That has obviously come to a pause or a halt, but long term, this is a relatively small part of Thermo's business. And also, if you're an emerging biotech and you have a compelling drug, you're going to find another way to find funding. So long term, we think that Thermo is in a really good position, and we've added to the position, even though it's a relatively large position in the portfolio year to date. Progressive Corporation, they're a relatively new name in the portfolio. I think we purchased the stock in the first quarter of this year. I'd classify them sort of as a non-traditional growth company, but they certainly meet our 14% criteria. We see them as sort of high teens, 20% grower as we look out over the next 3 to 5 years. And there's a couple of reasons why we really like this stock compared to some of their peers. They are a direct-to-consumer model. So a lot of their peers have to go through an agent, which certainly impacts profitability. They are, I'm sure you've seen their ads, they are hyper-focused on the younger demographic. That is typically a cohort that is very comfortable shopping and browsing online for their insurance products, so that puts them in a really good position. They also have the best underwriting. They have been tracking their drivers' habits for longer than any other company in their peer set, so that does give them an advantage. But the reason the stock is down a little bit year to date is actually because there was a tort reform in Florida really focused on some ambulance chasing lawyers, so they've removed the ability for one-way fees from an insurance company directly to a lawyer. Now if you're an end customer and you want to sue the insurance company, you will have to pay the lawyer for that. So long term, we expect that to actually be a benefit for Progressive, but it did sort of cause this flood of new cases in March ahead of that tort reform going through. Let me stop there to see if there are any questions on any of the top or bottom 5 names.
Just to your point, I got a client who's a very statewide, well-known litigator in that area. He said, yeah, there's going to be a lot of lawyers looking for jobs after the passing of that, which kind of feeds into your
They also lowered the statute of limitations.
Here in Florida.
Here.
Yeah, right. So, he does a lot of mediation arbitration. He said, yeah, some of the big firms are already starting to lay off. So again, it makes sense.
Yeah, so the stock traded down because of that very short-term influx of cases, but long-term, we're really happy to have Progressive in the portfolio. And again, it's a little bit of a non-traditional growth company.
We have just over 5-10 minutes left. What questions are there from around the table? Any stocks of interest? Doug can certainly go into more depth on 2022, but I would love to hear from you all. Outlook, maybe?
Why'd you open the Tokyo office?
So we see opportunity in Asia, clearly. We've had an office in Singapore for several years now, and this was sort of our next step. Japan is a very kind of insular market, and so it took us a while to find somebody local. We didn't want to drop somebody in from London or the US and try to do it there. So we were working our networks out of Singapore to get to know people in Tokyo and find the right cultural fit to represent Brown Advisory there. And his name is Toshi Mirasawa, and he visited us recently in Baltimore. He's very outgoing. Obviously, he's from Tokyo, knows the business, and he's just the right person.
To invest in Japan?
Well, he's going to be more distribution. I'm sorry, I should have said that up front. So he's doing relationship development, finding partnerships, finding potential clients for us, both on the institutional side and through other partners. And then eventually, long term, I would not be surprised if, as we continue to grow our global, we have a global equity strategy and a global international, non-US equity strategy. I could see us adding an investment piece there over the medium term.
Doesn't there seem to be a lot of bad news coming out of China economically?
Yes, absolutely. We've done a lot of work to really understand as much as we can the exposures that we have there. And that's why Estee Lauder, we do have a lot of confidence in the fact that they are playing in the prestige category. So we like consumer products that skew to a higher demographic. They're more resilient in nature, but yes, we're certainly monitoring what is going on in China very closely. Intuitive Surgical is another large position, longest held position in this portfolio. They have a lot of exposure, probably somewhere between 15 and 20% of their business is in China. But if you think about medical technology, I mean, China wants to be on the leading edge as well. They're not going to pull back on advanced robotic
But
surgery.
you're generally not investing in China tech.
Correct. Alibaba is a name that we owned. We probably sold it in 2018 or 2019, and Ken just thought there was too much risk in that. He didn't want to wake up one day and the CEO of
Yeah,
Alibaba be missing.
good thing.
I was talking to a hedge fund manager a couple of weeks ago. He made an interesting comment. I was curious what your thoughts are. He said basically, all these the very large concentration, on these large technology companies. And of course, the question is, any private equity group says, what's the maximum addressable market for this new product technology? He said really the largest addressable market for these big tech companies are each other, which I thought was an interesting comment and about how's that going to drive down profitability if they start basically trying to go, poach each other's business, because they kind of maximize their initial potential. Can these huge companies, what's Microsoft going to do? Obviously in the business, but they can start selling ice cream. I mean, how do they get that additional revenue? So, given that comment, I'm just kind of curious your thoughts on it.
Yeah, really good question. And it's a tough one to answer, but I mean, really the businesses that we're looking to invest in have a competitive edge. I mean, that is really where we're trying to focus. I mean, Microsoft is a really good example. Long term, there will continue to be a transition to the cloud. We think that we're in the relatively early innings of that. We have 3, Google, Amazon, and Microsoft are all significant players within the cloud space. We think that there's enough room for multiple years of growth onto those cloud platforms. But the other thing that I think is really important to highlight is, especially from a tech perspective, we really like vertically integrated software companies. That's actually when you again drill down into tech, we actually have an overweight to software. Most of that skews vertically integrated, and the reason that is because we want these companies to penetrate an enterprise, cross-sell as much as possible, and then they almost become impossible to rip out. So that's really how we're thinking about it from a tech perspective. Clearly, a lot of the tech performance this year has been driven by just excitement around AI. And if we enter a period of time where, hopefully we'll see this in the back half of this year, where companies are not just going to be able to talk about rolling out an AI platform, they're going to have to show how it's going to be profitable. I think this portfolio sets up really well. And it takes a lot of work. I mean, you really have to dig in and understand how each business model is operating from an AI perspective. I mean, Intuitive Surgical, the robotic surgical system, probably doesn't come top of mind when thinking about AI, but they have been tracking every single surgeon's move on their robot for over a decade. That is incredibly powerful data. So if you're a young surgeon entering a hospital in Florida, you can say, I want to train against the top 10% of surgeons at removing the gallbladder. Intuitive can do that, again, which just makes their business even stickier.
Kind of a general question about your holdings and, compared to the index and, the overweighting of the FANGs or Megatech 7 or 8 or whatever you want to call it. I think a lot of the reason that we look at active investment as opposed to passive is this idea that, a lot of the performance of that concentrated group of companies is maybe somewhat irrational. Maybe they're overvalued, or maybe they're more susceptible at some point to a downside. Yep. But we've been thinking that for 10 years or 12 years, right? And so I guess my question is kind of more philosophical. At some point, do you reevaluate, because these companies do appear to be the leaders in their industries for the most part. So do you reevaluate your willingness to own, a larger weighting to those and incorporate that into your active management, or do you just continue to limit it going forward?
Yeah, really good question. This conversation has come up a lot, and I think Ken is, again, he's been doing this for over a quarter of a century and is very consistent in the application of the process. And the reason he likes the 5% rule does not have to do with the underlying benchmark. It is a risk mitigation tool. But you're right, it's absolutely been a headwind, and we'd love to own Microsoft at a larger position, but a risk mitigation tool is there, and we're going to stay consistent to that. But there is one other slide on here, just as we think about sort of the benchmark and how it's been concentrated.
dividend on Microsoft might encourage it too.
Yeah,
And it's increasing at 12% a year. It's sort of the picks and shovel of technology.
I mean,
Becoming
it's a
Yeah.
great resilient business model. That's why it's one of the largest positions that we have. But I think slide 16 is an interesting one. Certainly, the Russell 1000 growth has been concentrated for quite some time. And this is a stat that I track closely. This is a chart going back to 1993. You can see in the late 90s, and what these numbers are showing you is that the late 90s, the benchmark was being driven by 46 stocks. Flash forward to today, the benchmark, which again has 440 stocks in it, is being driven by 23, which is just incredible. Right? It's pretty staggering when you think about it that way. So when you tie this back to thinking about risk, clearly the benchmark is probably the riskiest it's ever been. And we know these business models really well. We know Apple really well. Over 4 PEG is incredibly expensive. They are exposed to the consumer and not the ultra high-end consumer. They are exposed to the consumer. And to Mary's question comment on outlook, if we enter a period of time where the Fed says, okay, we're probably done raising rates, probably 2 things will hopefully happen. A lot of the companies, high-quality companies in this portfolio that are well below their 5-year average from a valuation perspective will start to be rewarded, and people will stop viewing a company like Apple as sort of this safety play. So again, we're focused on, go ahead, sorry.
No, I appreciate that. But could you talk to page, the slide 17, page 17?
Yeah, absolutely. Yeah, so this is a snapshot of the trailing 12 months, or the beginning of 2022 through the end of the first quarter. And really what this is highlighting is that underlying fundamentals in 2022 essentially didn't matter as much as sort of underlying growth rate and underlying valuation. And you can see almost in lockstep by quintile, you can see the higher growth, the higher the valuation that came along with that, the more your performance declined in the Russell 1000 growth. And that was certainly part of the phenomenon that we experienced in 2022. Shopify was one of the poorest performers in the portfolio in 2022. Hyper growth company, high valuation that came alongside of that. In the first quarter of last year, they said we're not focusing on profitability as the Fed started to raise rates. We're going to invest in growth initiatives. The stock plummeted on that news. Long term, fundamentally, still a great business, a leader in sort of their respective arena from an e-commerce perspective. The stock rebounded, I don't know, somewhere between 75 and 80% this year, and we did exit that position in July.
So this chart is showing a couple of stories at once coming together. Just want to make sure, I think it's very compelling. Basically, when we look at the index, sometimes we break it down into quintiles on a number of different measures. This one, you're looking at the returns on the vertical axis, the return over that 5-quarter period. Of the components of the Russell 1000 growth divided up by valuation, EV to sales multiple. And so starting at the far left, and you look at the horizontal axis, greater than 11 times the highest valued stocks growing the fastest, if you look at the growth rate at the top of that bar, underperformed. So they were down like 30%. And then beneath that, you see we have a 15% relative overweight. So what we're showing here is the parts of the market that are fastest growing and have the highest valuation is where our overweight is, and it did the worst. Hopefully everybody sort of got that, but I just wanted to sort of tie together those components.
I guess the way it's point to be changing your style is a big red flag. You went with a big stuff, but then 12 years at 300 basis points behind is a lot of money over 12 years.
Right, yeah, it is. So we are sticking to our style. It's if we were to sort of go in the other direction and say, all right, let's own Apple at 15%, let's just do it. It's driving the market. Let's just try to gain some return out of that. I think a lot of our clients would lose faith in us. So
Is that what the new investigative guys are? Is it the strategists looking forward? Is that?
well, they're looking at particular industry dynamics that help the fundamental analysts do their job. So it's very, I guess it's microeconomics, really.
Yeah. So a couple of other projects. I mean, they've worked on a tech regulation project. They've spent time in DC. They've talked to regulators in Europe to understand what might be coming out in the US from a tech regulation perspective. They worked on a project regarding sort of the electric grid in the US. So those are some of the projects that they work on that sort of have broad implications across lots of different investments, both for the large cap growth portfolio and other portfolios that we have in Brown.
And so their deep project-oriented
Yeah.
research, which is not connected to particular stocks, informs the fundamental stock analysis that the fundamental analysts do that are shown on the page. So it's kind of like, these fundamental analysts, they cover a number of stocks within their sector. There's certain issues they don't have the time or the bandwidth to look into. And there's certain issues that might cut across a number of sectors. And so that's this project that then gets assigned to the investigative analysts. And they're sort of like journalists. They go deep, they talk to a lot of fundamental sources, and they come back with their findings that helps fundamental analysts complete their models and do their work and analyze the stock and the company that they're looking at. We started that about 5 or 6 years ago and have built up the team. It's been very useful to our research work.
And to your comment on sort of long-term performance. No idea what you clicked there.
We've all been there.
Sorry about that. We can make up a lot of relative performance in a short amount of time. I mean, we try not to focus on short-term performance, but June is a really good example of the top 7 companies only accounted for about 50% of the benchmark's return. We had 3 or 4 companies report very solid fundamental results, and we outperformed by over 200 basis points in a month.
Just historically, and I'm a bit of an economic historian, but if you go back, when you see markets get this concentrated, go back to 1965, 73, 1999, 2007, and today, the subsequent return on those popular stocks is really sad. And so, again, you see that type of concentration. Now, maybe, as Mark Twain said, virtue doesn't repeat itself, but it rhymes. When I look at that level of concentration, historically, that's not been the time to jump in and own what's gone up the most recently. So I know whether that plays out this time will tell. But
And I mean, to your point, I mean, if you look at 2000, 2001, and those were the best periods of time for active large cap growth managers in recent history. And certainly this portfolio participated in that as well.
so, very good. And appreciate, again, as always, your candor and discussion. Any additional questions from anyone on the committee, staff? No? Well, great. Well, thank you very much for showing up in Florida at the end of August. It's probably the more opportune time to show up here, but thank you.
The weather was very mild. Thank you.
It's been hot in Baltimore, too.
Very good. All right. Anybody need a break? Or we go on to our next presentation? All right. Mr. Gerber from Twin, the floor is yours. Do you want to sit maybe at the head of the table?
I will be glad to. Let me do that. And let me also apologize. I was here last night staying at the Hilton University. At 8 o'clock in the morning, I go to my car. I worked last night. I worked yesterday afternoon, driving up from Orlando. Went out to dinner last night, worked, and go to my car this morning. You know, it's 85 degrees, and I'm from the north. I'm already sweating, and the car won't start. The key lost its power.
Oh, my God.
The key lost its power. Yes. So if you could pass those around, please, and then I think there we go. Pat, Harvey, Matt. That's what you have. So I do thank you. I'll go to the head of the table, but I do really apologize for being late. I really. I wound up getting a lift from the University of Florida's police officer because he was in the parking lot. There was apparently an accident earlier, and he was in the parking lot, and I waved him down, and he helped me. While I was talking to National, he agreed with me that there was no way to start this car, and the Uber couldn't find me, so he took me here. So I made it here, 9:02. I'm very sorry for the delay, but thank you. Thank you. So to get into it, to start, first and foremost, it's truly a pleasure to see everyone here. So thank you for having me. An update on Twin on page 2. We're still about the same $1 billion of AUM and AUA that we were, last year roughly at this time. The one change, I guess, that's worth noting is in June, P&I came out with their latest rankings of money managers, and Twin moved up 1 slot. We are now the 9th largest enhanced index manager in the country. So obviously, while we only manage $1 billion of assets under advisement, we really specialize in doing enhanced indexing. So comparatively to Brown Advisory, we're just kind of the opposite. We're giving you a very diversified portfolio. We actually are actually giving you a slight overweight to the Mag 7, which has actually helped performance this year. But yet we still were able to outperform last year when the market was down. So it's an enhanced index strategy. To remind you of the strategy on page 4 and page 5, what we're trying to do is look at the market portfolio and try and add value to the benchmark while controlling for the risk we take. So we really focus on adding value relative to the tracking error or active risk. So we really focus on what's called the information ratio, giving you the best information ratio possible. So the way we do it is we start off with a model. We are basically buying stocks that, as you see on page 5, that are cheaper than their peers, that have more earnings growth potential than their peers, that have improving quality metrics relative to their peers, and we're simultaneously looking to sell stocks that are overvalued or have negative or declining expected earnings growth and have deteriorating quality metrics. So that's what we're looking to do. On page 6 is an overview. We have elements of valuation, we have elements of growth, and we have elements of quality. Because we are not trying to be a growth manager, we're not trying to be a value manager, we're trying to be a core manager. We're trying to give you that market index with a return that beats the market index over time, but without taking a lot of risk. And obviously, we also charge an incentive fee that allows you to participate in the market, in this case, where your gross and net are the same until we outperform. So the process on page 6, kind of, you have these valuation metrics, you have these growth metrics, you have quality metrics, you put it into a model, and you build a portfolio that's designed to beat the benchmark. That's designed to beat the benchmark. The portfolio description on page 7 has not changed in the 5+ years we've been managing money for you. We hold a diversified portfolio. It too is relatively low turnover. We've only averaged 27.5% in the 5 years you've been with us. We've also just actually completed 19 and a half years of track record. So we're going into our 20th year. To get to your numbers on page 8, you started a little over 5 years ago, in 2018, with 33 million. You took out roughly $5 million over the next 3 years. At the end of November 2020 and into early 2021, you did your pension obligation bond, which I'll focus on in a minute. Then after that, that was 20 million in, 5 million out the next 3 years. So net asset flows in are $42.9 million. And the value at the end of July was 70.7. So you could see that's almost $28 million of net gain. From a return standpoint, it is 11.3%. It is behind the 12.4 market return. All of that came in the first 2.5 years. Since then, we've outperformed. But the other point worth mentioning is while we've done a return of 11.3 that underperforms the benchmark, we've also done it with less risk. So we've done it by reducing your overall volatility, 18.6 versus 18.9. If you look at it more recently, since the pension obligation bond, when you had your meeting, and we had our meeting with all the managers, we told you at the time we had underperformed. We told you at the time that's going to turn. That was all true. So if you look at the performance, you put in $20 million over a 3-month period. In the 31 months since you've completed the pension obligation bond, you're up 9.2%. The Russell 1000's up 8.5. And year to date, you're up 21.4 versus the market up 20.7. And I think that the last 2 years, as I point out on page 10, have really been distinct. I mean, you're talking about 2 years in a row where you're starting out within the first 7, 8, 9 months, your market's up or down 20%. Last year down 20%, we outperformed. This year up 20+%, we outperformed. And that's really the goal of an enhanced index. We can't do it all the time, but that's really the goal of an enhanced index. We protect you on the downside. That's something we really focus on, but participating on the upside is also really key. If you look at the 2.5-year period, I have an attribution report for you. For that 2.5-year period, it shows you that we added value from asset selection, from risk indices, not a lot from sectors. We're not trying to time sectors. Remember, our portfolio, your portfolio, sector by sector looks just like the market. So whatever the weight is, if technology is 28% of the market, you're going to be roughly 27 to 29% in your portfolio. We're not looking to take big sector bets. We're looking to buy the best stocks within each sector. That's really what we're focusing on. If you look at the long-term returns on page 13, obviously over the whole long-term period, market's up 9.7, we're up 10.7 or 10.8. We are outperforming. We're producing a tracking error of less than 2%, which is our goal, and an information ratio of 0.5, meaning that we're adding 0.5%, more than 0.5% of value added for every 1% risk. The way we do this with an enhanced index, the performance of an enhanced index, the goal of it is really, you can see on page 16 and 17. So on page 16, you see 3-year numbers of the market, and you see 3-year numbers of our strategy. And so the way you look at the chart on page 16 is if you see the diamond in the green shaded area, you're outperforming. If you see the diamond in the white area, you're underperforming. Notice the first thing, when the market's 5%, give or take for a 3-year period to negative, we're always outperforming, always. When the market's up 5% or more, most of the time, we're outperforming. I'll point out one diamond that's worth noting, this diamond right here, the far right. That was the 3-year calendar year period, 2019, 2020, yes, the pandemic. 2021 was the best 3-year period since actually 97, 98, 99. Market's up 27%, we're up 26 point something. We keep it close. So the idea is we know we can't outperform all the time, but when we lose, we understand that investing is asymmetric. We understand that a 10% loss means 11% gain to get back to neutral. A 20% loss means you need 25. The more you lose, the more you have to get back. If you lose 50% because the market gets crashed, you still have to spend 5% to make your benefit payments. That 5% on top of the 50 doesn't cost you 6, doesn't cost you 10, doesn't cost you 15, costs you 22% because you already lost 50. The more you lose, the more you have to get back. So our goal is we know we can't win all the time, but if we're going to lose, let's be as close to that 45-degree line as possible. And when you do that and you see that you can beat the market 72% of all 3-year periods, almost 3 out of 4 periods, relative to peers, you look even better, because peers have a tough time. So if you look at page 17, while our batting average is 72% on a 3-year basis relative to the market, it's 81% relative to median managers. We beat the median manager 4 out of 5 3-year periods. We beat the median manager 85% of the time on a 5-year basis, and even on a 1-year basis, 7 out of 10 1-year periods, we're beating the median manager. So we're trying to we're not trying to hit those, we're not going to hit your home runs. We're not going to be your Brown advisory. We're not going to hit home runs. We're going to hit a lot of singles, some doubles, and just try and score more often through time.
Jeff, could you remind me again, I think you have the incentive fee structure, so if you underperform, then is it discount or we waive the management fee?
No. So the incentive fee, and it's funny, John, you've asked about this before. You asked about can we pay the light, so we're still in business, obviously.
Right.
So we certainly paid that. I did learn one experience. So what we have is we have an incentive fee that you pay us zero. Zero base fee, zero fee at all, unless we outperform. And we did it with a high watermark.
Okay.
And so because we are behind from the beginning, we're catching up, obviously. We've caught up a lot in the last 2.5 years, but because we were behind in that 2020 period particularly, we're still a little bit behind. So we have not gotten a payment yet.
Okay.
We have learned from our experience, and so now when we do...
He didn't offer it to the next.
Yeah, we have learned from our experience, and now we do... Right, but we're not, but we do now 3-year rolls.
Okay.
So if we did a 3-year roll, we would be getting paid this year because we were getting paid, but we didn't do that, and we're not coming back to you and asking for any changes. We're very happy with this relationship. We're happy with the relationship with Gainesville, with ANCO, and we are honoring, but I do feel confident that we will get paid in a year or so.
Okay.
That I do feel
And
confident. We're getting.
You're not driving down instead of flying.
I'm not driving down instead of flying. I flew, although the car didn't get me from the hotel 2 miles a year. It did not. And it won't get me to the Jacksonville airport for my flight this afternoon. It will not. But anyway, that's, the car was left, and they actually said to leave the car. I mean, the police officer was shocked too. I had the key. Once I locked the doors, I was able to get the car open, but I couldn't start it. Once I locked the doors, she said, well, I said, I'll leave the key and leave the car door unlocked. She said, no, take the key. So I did, I locked the door. I can't get back in the car anyway now. So I don't know how they're gonna even get in the car and I have the key. They told me to take the key. I said, officer, you heard them say that. They said, yes. I have his card, and he's a Steeler fan, so when he comes up to Pittsburgh, he'll get to see a Steeler game. So he got me here in time, so it all worked out.
Are you okay getting to Jacksonville?
I'm going to take an Uber to get to Jacksonville, yes. So thank you, William. Thank you. I will get there. I know some of you probably live up that way, but I know you're going to continue after I leave. So I do thank you. But yes, it will be not a cheap Uber that's going to be put to National. National's already told you're paying for this bill. So anyway, so I hope I answered your question, John. Great. So I talked about returns on a 3-year basis. On even a 1-year basis, we have a great batting average. The reason for it is on a monthly basis on page 18. You can really get a good feel for what happens on a month-to-month basis. In the 19 and a half years we've been managing the strategy, the best month for the Russell has been 13%, the worst month has been 17 negative. Over all months, we win on the far right. When the market is up 2% or more, we keep pace with the market. We have the same average return, we have less risk, so it's still better off. You look at months where the market is sideways, call it plus 2% to minus 2.5%. We win nicely. You look at the months, there's the fewest of them, fortunately, but you look at the months where the market really gets slammed, down 2.5% or more, that's where most of the value added comes. Not all, but a good portion of the value added comes from that period.
If I could just jump in, sort of related to some of Brown's comments and other things we've talked about. The concentration in the market leads to risk.
Yes.
That likely turns at some point. You had mentioned that your portfolio is benefited by being near or even overweight some of those larger names. So
Yes.
my question is just sort of mechanic.
Yes, how does right.
How do you pivot
Yes,
when that changes?
so we've already started the pivot. So basically, in fact, just to give it to, looking at page 19, those are showing the exposures, Brendan. The far right, just to get through that, far right sectors. Notice, no sector more than 30 basis points over or underweighted. You'll notice that technology slightly over, communication slightly over. When we looked at this in the past, you saw they were slightly negative. We make little shifts, not big shifts. You look at the bottom of it, dividend yield right on the market, beta right on the market, expected tracking error still low relatively at 1.2%, 1.18. That's the right side. What you're talking about is the left, our tilts. The 100 largest names are currently 2.1% underweighted. We are now underweighted to the largest 100 names. To the Russell Top 200, we're 1.7 under. If you look at the two rows, the minus 2.1 plus the 0.4. Everyone follow? So another way to put it is the Russell Top 200 is 77% of the market. And we are 76% of that. Now, if you go look at page 20 for a second, and I apologize to go back and forth, look at where we were at the end of June. The top 200, we were actually large. We weren't small. In fact, at the beginning of the year, we were mid-cap oriented. As December 31st, we were 4.2% overweighted to the mid-cap. We recognized, Brendan, this year, that we had to do something about that Mag 7. We recognized that they were driving the return and that it was likely going to continue. And So we actually, you could see, we shifted from mid-cap to large cap, all within a 6-month period, with relatively low turnover, because we focused the turnover on those cap names. I could tell you at the end of June, the Mag 7 were collectively, there's 8 stocks, 7 companies. We were overweighted by 2.4. As of today, you're overweighted by 1.6, 1.55. We brought it down by about 1%. We will continue to bring it down, Brendan, because I do agree with you and with you, John, that that's the right way to go. But that's also why I wanted to point out that when the market was down 22%, we outperformed by 90. Market's up 20+%, we're outperforming by 70. So it's small shifts at the margin that really is what's necessary. And if you get them right, you know, you're 2.4%, that's all you need. You don't need to have a lot, because we're not trying to take a big bet. We're not trying to take a big bet. Similarly, you could see we've also brought value down dramatically. We brought value down. Value really helped out last year in 2022. It was right to be value. You know, yes, do I wish it switched sign? Yes, but again, you also have a question of turnover, a question of risk, and trying to manage that. So I hope that helps, but the bottom line is that, you know, we can affect that, and we will continue to be reducing those, at least as we see it today. That could change, but as we see it today, I would see us eventually being underweighted by year end to that. We're already underweighted now to the top 200. So we've made that move. But again, we don't want to, you know, shove it. We do it slowly over time.
And the underrates, if you're trimming something that's run, you're applying basically the characteristics that you had on page.
Absolutely, absolutely. So right now,
what do you see?
So for specifically,
do you see deterioration?
Yes. So specifically, Apple.
Okay.
Apple was a 35, 40 basis point overweight. Now we're basically neutral to it. It has now a negative alpha. It had a very, very positive alpha.
Right.
At the same time, NVIDIA has a very, very positive expected return.
Right.
And it's still running and running and running. And we haven't trimmed that. But we have trimmed Apple. We've trimmed Microsoft a little bit. Again, those were more negative alphas, but we did not trim NVIDIA. So that's kind of, but yes, we're going to use the alpha and also the risk of that stock and how much risk it contributes to the portfolio to determine where we trim.
Okay.
But yes.
When you say risk, valuation risk, volatility risk, what are you?
Tracking error risk.
Tracking error risk.
Yeah, so basically what we want is, so for example, we can't just completely sell out of the Mag 7 because that each stock, the biggest underweight or overweight in your portfolio stock by stock is about 1%. So if we wanted to underweight Apple, we're still holding it at 7, not at 8.
Right.
And so we're not like, you know, the Brown, we're just, I mean, you could be in the index fund. And obviously that's your call. We're going to try and beat it. We're going to also try and beat it with less risk, which we've done. We haven't beaten it over the whole period. We've beaten the last 2.5 years, but we've always given you less risk. And we give you something that's really close and tight. So we're trying to give you, I mean, you are clearly at you know, City of Gainesville, your high equity exposure. We're going to be your safe equity exposure. And then let Brown and others be your kind of satellites. So that's kind of how I view the enhanced index fitting in that way. I hope that helps.
Yes, thank you.
Good. So thank you. So just some market stuff, because that's really the fun stuff. So to talk about page 21, this is only through June, but to the point that that Brown was bringing up, the market did get much more diversified starting in June. So in June, if you're looking at here sectors, you're looking at equity indices, and you also have the bond indices in here, 2 bond indices. And if you look at it, clearly what's driven the market year to date have been the 3 sectors on the left, which would be all the growth sectors: technology, communication services, and consumer discretionary. At the far right, the sectors that are negative year to date would be the utilities and energies and healthcare and financials and staples being basically flat, the value sectors. So you clearly have this bifurcation that took place mainly through May. June, it started to diversify. July, it continued to diversify. In August, it started to come back the other way a little bit, at least for some stocks like NVIDIA. But overall, the market is getting much broader since June, July, and August. But the other good thing about the market is in the second quarter, as I point out on page 22, volatility came down dramatically. So remember, we reported to you last year that last year was unique in terms of the number of days that the market moved up or down by more than 1%. Half the days last year, the third highest calendar year since 1957. Unfortunately, in 2022, they were mostly down days. But this year, first quarter, market turns around, is up. First quarter, 46% of the days were still big volatile days, 1% or more moves. Since then, much less. In fact, since February, we've had no 2% moving day, ever. No 2% moving day. It's just striking. There's this great chart from the journal. It only went through May, but it was on page 24, so I thought I'd just borrow it, certainly with citing them. It was in the May 30th journal, but it's a nice, pretty picture that shows you day by day. Each row is a month in that calendar year, and you can see that there have been no red dots since February, which compared to the amount of 2% days last year, which were voluminous. So we talked about the market being led by very few on page 25. You just looked at it relative to the S&P, to the Russell 1000 growth, to the pure core index. The S&P 500 year to date through June is up 17%, 16.9%. Yet 40% of the names, 197 companies through June, are negative for the year. Much less underperforming a 16.9 positive number. They're not 5%, they're minus 5%. I mean, 200 companies are down year to date through June. So it's not all companies are participating. It's really not. And to your point, John, that doesn't stay forever. And I have a nice picture to show it. But when you get these bifurcations, as I point out on page 26, you get a bifurcation. The Mag 7 are listed up on top. They produced a 43% half-year return for technology, a 36+% return for communication services, and thank you Amazon and Tesla for getting consumer discretionary up in the 30s as well. So basically, you have this bifurcated market. The other sectors are flat to down. That is going to change. But as we point out on page 27, what really drives active management, what drives the ability of managers to add value is, look, I teach at Wharton. As many of you know, I teach executive ed at Wharton. I teach manager selection, investment policy, asset allocation, manager selection and evaluation. And I always point out that now I've been successfully managing institutional portfolios for 40 years and adding value over the long term. And in another 38 years, I'll be able to tell whether that value added is statistically significant. But that's the reality of the statistics. It's just the reality. It's the reality. So what you can do, though, is you can measure the probability that a manager picks a winning stock. So let's agree that we can't measure a manager's skill in a manager's lifetime, but we can measure the probability of them picking a winning stock. That's very easy. If I put up a dartboard with 500 pixels, we all get a dart to throw it. We all land on a pixel. Whatever pixel we land in, that determines the stock. So you bought IBM, I bought NVIDIA, you bought Progressive. We all buy a stock wherever the thing lands. Question is, out of our 8 darts, how many win? Well, it's simple. How many stocks beat the market? If 250 stocks outperform and 250 lose, what's our expectation? 4 of our darts win, 4 of our darts lose. If 400 stocks win and 100 stocks lose, we're probably going to have 6 or 7 darts that win. If only 200 or 150 stocks win, we're probably going to only have 1 or 2 of us, maybe 3 of us, have a stock that wins. So we actually show you that. We actually calculate what the breadth is. So it relates to Breadth, it relates to dispersion and concentration. Just to get concentration out of the way on page 29 for a second, John, to your point, this is now the broad market. As of the end of June, the 5 and 10 largest companies are the highest they've ever been. You're right, I don't have the 60s, but I do have the nifty, the 70s. We have, obviously, the late 90s. We have 2007, that little pop-up in 2007. And in every case, John, you're absolutely right. After those peaks, it comes down. It comes down. It comes down sharply, in fact, after those peaks. The other interesting thing for those who like market historians, 1975, Kodak. Does anyone remember Kodak Photomats? I mean, just to make sure. Yeah, the booths.
You always wonder where they went potty.
Yeah, you did wonder that. You didn't want to go in the booth to find out though, Harvey. So Exxon, Kodak, General Motors, I mean, it's just amazing to think about the world and how it's changed. So to get to the breadth, go to page 31. This is simply the chart I was discussing. It's showing you, some might like to call it the Christmas chart because it's red and green bars, but it's showing you the percentage of S&P 500 stocks that calendar year beat the market. With, of course, through far right, only through June of this year. So every other year is a calendar year. If you see a green bar, that means that my guess is that you'll find the median manager beating the market. If you see a red bar, the median manager is not beating the market. The market's beating the median manager. And in fact, we'll show you that in a second. It's high degree of correlation. But the point is that when you have a period like this, that's going to make it very hard. It can make it very hard. It's going to make it hard for a concentrated manager, much less a diversified manager, if they're not concentrating in the ones that are winning. And so it's been a very tough, 7, 8 out of the last 10 years, 9 out of the last 11 years have been red bars. And not just red bars, but declining red bars, in the mid-30s. This year, 28%. 1 out of 4 stocks beating the market, 3 out of 4. Do you expect a concentrated manager to find that 25% of the stocks easily? Maybe, but that's not an easy thing to do. So the proof of the pudding, and this is something, Brendan, that you and your research team have seen before, page 32, is showing you breadth. Back to 1975. So rather than showing you the calendar years, year by year, you're now looking at each red bar on page 32, showing you a 12-month breadth measure, 12-month breadth. So basically, in 2022, breadth got very broad. The market got broad, but then dramatically declined to this year. Really fast. Very, very fast. Again, relating, that's part of what we use this in part. When we see that coming down, that's when we know, when we start the year off heavy mid, we see it coming, we know that we got to make a move. And that's why we did. So breadth coming down, breadth going narrow, and the blue line is the median manager's excess return. The median manager's excess return. So there's 2 different axes here. The median manager's excess return on the left axis, breadth being 50% on the right axis. Notice it's very simple. Very, very simple. When breadth is above 50, the active manager is likely winning. When breadth is below 50, the active manager is likely losing. It's very, very simple. It really does. It doesn't tell you how much they win or lose by. That's the next page. The next page is dispersion. So this is telling you, okay, you deviate from the market, how much do you win or lose by? The higher the red bar on page 33, the higher the red bar, the more the shit hits the fan, or the more they look like a genius. And so what's happened is residual risk has gone up. Breadth has come down. That's been very, very tough for managers, particularly even concentrated managers. So what happens after that kind of market is usually a reversal. Usually there is a reversal. Breadth will come back up. And it typically comes up because the Mag 7 or the ones that are leading the market take the big hit. And that's usually then what happens. And then all of a sudden they take the hit, and then all of a sudden, like 2000, 2001, and 2, you see extremely high breadth and you see extremely high value added of managers. Late 90s, just the opposite. Last 5, 10 years, just the opposite. So that's really, really important. The other pages in here, just in terms of page 36, where does the market go from here? Just to talk about that, I will say that it's important to note that analysts are not projecting that recession. They are still projecting a fourth quarter earnings growth that's very positive. They're expecting a third quarter that's basically flat, slightly positive, but they are still forecasting positive growth for the fourth quarter and barely positive growth for this year. We've had 3 negative consecutive quarters of growth. If they're wrong, then the market's going to react negatively quickly. If they're wrong, that's a risk. The good news is that the PE ratio is higher than average, but not off the charts higher than average. So, the forward PE multiple is 19. The 10-year average is 17. The 25-year average is probably more like 15, like 16. So you're high, but you're not in the mid-20s, the low 20s. So you could take that hit, but it may not be as bad ahead. It may not be as bad ahead. Inflation certainly has come down. The Fed's done a nice job bringing inflation down. It's not at their 2% target, but it's certainly come down from the 9% level just a year ago. The yield curve, as we know, is still inverted. That bond market is now having the bear steepening. You got the 10-year at 4.2, 4.3, becomes a lot more appealing, but you still got your short rate at 5+. And so they're still saying there's going to be a recession, that the Fed at some point is going to cut rates. And so if you look at, perhaps maybe the yield curve on page 42, that was the yield curve from earlier this month. Page 43 is a good reminder that the yield curve inversion, it may be an 18-month lead indicator, but it's always produced a recession, according to the NBER. Now, fortunately, the NBER, which determines those yellow lines, they tell you you're in a recession after you already know you're in a recession, and they tell you you're out of a recession after you already know you're out of a recession, but it's the only measurement of the recession. So if you look at it, prior to each of the last 10 recessions, yield curve inverted prior to that. The other thing that happened prior to each recession that hasn't happened yet is unemployment rose. So if you look at page 44 is showing you that prior to each recession, the unemployment rate rose through the recession and peaked at the end of the recession or post-recession, peaked at a high level. We're at a 50-year low on unemployment. We're just a tick or two above the 3.4 50-year low. We haven't moved off of that. I think that really is the indicator. It's what clearly the Fed has been looking at the labor market, because they see inflation coming down, and why are they still talking about higher for longer? Well, because the labor market is not participating yet. It's not doing what they want it to do. They want to see more unemployment. So that's kind of where we stand. We think that going forward, if the stock guys are right, it's wonderful, and the market's going to continue. But I am very concerned that there could be some disappointments in the fourth quarter earnings, and I think, I've been in the business for 40 years, and someone told me when I first started the business, the bond guys are a lot smarter than the stock guys. I don't know if that's true or not, but I look at that evidence and I say there's probably going to be a recession. It's not coming this year. Maybe it comes in 2024, maybe not even until 2025, but it's coming. And certainly there's already been a turnaround in the market leadership in terms of the leaders taking a breather. And whether they take off again and earnings are really positive, that's why we don't go from +2.4 to -2.4 in one fell swoop. So that's what we're evaluating. The last page is a page I love to use because it really kind of reminds people that in the end, earnings yield and bond yields do move together. And they move together alongside of inflation. So page 45 is showing you the gray line. The gray line you could see is inflation in the late 70s, peaking in 17% in 1980, late 70s, early 80. It peaked again at 9% last June. Notice that if you look at this, the blue line is the 10-year bond yield. I'll talk about the red line in a minute, but the blue line is the bond yield. Notice that as inflation hits a peak, yields follow. Bond yields follow. What's the red line? The red line is simply the inverse of the PE ratio. It's the E to P ratio. It's the earnings yield ratio. So what you're saying is if you see the red line going up, the market's going down. If you see the red line going down, the market's going up because the price is in the denominator, just like bond yields, right? You know that, right? You know that if interest rates go up, prices of bonds are going down. If the yield is going down, prices are going up. Same thing with earnings yield. Same thing with earnings yield. So what you see here is when the red line is going down, the market's going up, but when the red line is going up, the market's going down. Last year, 2020, let's talk about 2020. It's easy to follow from 2020. 2020, March of 2020, inflation's at 0, even slightly negative. Bond yield, 10-year bond yield's at 40 basis points. What happens? Inflation takes off dramatically. Bond yields, eventually, they follow. What happens? Then the red line follows. It's always the case that inflation leads the 10-year, which leads the equity market over the long term. Over the long term. So it's a useful chart to kind of remind you how things work together. I'll just end by asking for any other questions and also thanking you all. It's truly a pleasure to manage money for the city of Gainesville, and I'm glad that the last 2.5 years have been, I mean, while the numbers are in the 9s instead of in the 20s, that's because you have a plus 20 and a minus 20, but I'm glad we were able to outperform in both and for you. So happy to take any questions, and I hope this was helpful.
Well done as always, thank you very much. Any questions from committee, staff?
Just the volatility.
Yes.
How do you, just mechanically, how do you trade that? I mean, it's down now, but I mean, when it's high, how you're always buying and selling something, right?
Yes.
How do you account for the market volatility in terms of bidding or?
So in our case, Pat, we have an advantage. While we are a quant, we're not a high-frequency trader. So we are not trading every day. Our turnover is a little over 25%, 27.5% for your portfolio since you've been with us. So basically, we're holding a name for roughly 4 years on average. And so we are not having to deal with the fact that there are a lot of 2% days and then all of a sudden not a lot of 2% days. Also, our portfolios are sector neutral. So when we're trading for your portfolio, if we're selling Apple, we're probably buying some other tech, unless tech became so overweighted that we're bringing its weight back down. So we're always kind of replacing a stock with a similar kind of sector stock for the most part. So if it's a highly volatile day, we trade through the day, but we're trading on both sides of it, if you follow. Yeah, so we're trading on both sides. So it hasn't really hurt us. Obviously, it has much more impact on high-frequency traders, people who are trading every single day. Your portfolio, maybe last year, 13, 14 times was traded. That was it, roughly once a month, call it. I mean, this year there was a month where we didn't trade, but when the regional banks hit, we didn't have much regional bank exposure, very little. It's only 0.6 in the benchmark. We may have had 0.4. The day that Silicon went under, that Monday, we sold out of whatever little regional bank exposure we had. We didn't need to have that. We could have the majors, mind the whole. So even when it's volatile like that, we're buying one and you're buying JP Morgan, you're still in the same financial sector.
So you're not that sensitive to the price, to the price of an individual stock. You're getting out of one at a low, getting into the other at a lower.
Yes, we're not, unlike Brown, which everything is a target price,
Yeah.
we're all relative. We're only concerned about relative performance and relative exposure. So, yes, if you're trading in two, they're going to probably be moving similarly. All banks move similarly. Yes, the regionals got hit more, but all the banks got hit. So we're buying, and we're also not doing it in big weights. We're not getting in and out of a name all at once. If we want to reduce our weight in Apple, and Apple's the largest weight, we're going from 8.5 to 8.2 or 8.1, maybe down to 7.5. We're not going to 0. So we don't have to worry about selling a huge position in Apple on a day where it's moving big, the market, one way or the other. Or sometimes last year, both directions, right? Last year you got both directions within a day. This year it's been more direct, So I hope that answers.
Yeah,
Good, thank you. Any questions?
Yes.
Oh, please.
So most of the managers that address us give us some indication of names within either their portfolio or perhaps even just a sub-portfolio that's us. And I don't see that in your literature here at all. Is there a reason you don't show that?
We have, we'd be glad to provide the portfolio. We're happy to provide the portfolio,
No,
Dave.
my question was, is there a reason you don't show it here?
Well, because we have 150 names. So,
Just as an example, because you saw it this morning, so Brown showed you the top 5 or 6 performers and the bottom 5 or 6 performers.
Right.
I find that interesting.
We could certainly provide that. We provided the attribution.
No, that's my question was, why didn't you show it?
We didn't show it because we like to think about the portfolio at the portfolio level. We like to think about the portfolio. The way we like to think about the portfolio, Dave, is described for you on our exposure page, which is page 19. That's how we like to look at the portfolio.
Okay.
So, but we would be happy. I could tell you that your 10 largest names are Apple, Microsoft, Amazon, NVIDIA, Google, Tesla, Meta. Those are your 7 largest holdings.
Because
Those-
they don't look so similar to the index.
Yes. So that's why we don't, but we'd be happy to. We're not trying to hide anything. We are like the index. So we'll give you that. We'll be glad. We will send that
My
report
comment
tomorrow.
was that I found, especially, I don't know why, just David Rader, I find it interesting to see the bottom 5 or 6 performers.
Oh, we would
What
be
is it
glad.
that didn't work and why? Because I think personally, I think you learn more from your failures than you do from your successes.
Absolutely. You don't really learn from your successes. You don't learn. You just
a result, I've
take
learned a lot in my life.
credit, right? You take credit for your successes, right? You learn from your losses. No, absolutely. I will be glad to. We will provide you.
I'm not, you don't need to, I'm just curious as to why you didn't.
Yeah, it's just because we
I
are
don't
so
think trying to
marked.
change you would be a good idea.
Excuse me? I'm
I
sorry?
think that's all right.
No, so obviously the bottom, if we could say, would be healthcare, energy, and utilities would probably be the companies in those sectors, and those sectors looked the best last year, they look the worst this year.
That's exactly right. If you look at total contribution,
Right.
if you looked at total contribution, that's exactly right. If you look at page 21, I could tell you that the utilities we held for you, the energy stocks we held for you are the worst performers. That I could tell you. I can give you the exact names. I don't have that off the top of my head here, but I can give
A year
you.
from now, 3 years from now, they might be at the other end of the spectrum, you don't know.
Well, in fact, that's exactly what happened. So it's worth pointing that energy, that's why, look at energy. Energy, for the 12 months ending June, are up almost 20%. The reversal has been this year. It's all been the last 6 months. Energy was the leader last year. So you're absolutely right. It went from the leader to year-to-date being the second worst. And that's why we're also not willing to take big sector bets. Because I can't call that. That's really hard to call. But I can tell you that I can try and pick the best utilities. I can try and pick the best energies. And I could perhaps outperform because while those are down, I still am doing better than that. And that's my goal, or our goal. But I'll be glad to share you both total contribution as well as relative contribution. And that changes a lot, right? Apple could be the biggest contributor, but if you're neutral to Apple, you're not getting any positive contribution to the market. So we look at both. So I apologize for not including that.
But just real quick, and then we're almost, we gotta go on some of the agenda, but the passive flows, do you track, I mean, what, of the
Yes.
new money going in, I mean, is the money still going more passive? The stat I read is like a year or two old, was like 68%.
Yeah, it's almost 70%.
70?
Yeah, almost 70%. So that was, I will tell you that, and, you know, Brendan and his company obviously would be better to answer this question because they have lots of clients, more than, you know, the 50 some odd we have. But I would tell you that, excuse me, sorry, I lost my train of thought. I'm sorry.
We're on the passive.
Passive, right.
flow.
I would tell you that the passive flows, I do think 2022 kind of will change things. It will start to change things. I haven't seen that data yet, though, John. I haven't seen it swing back.
Okay.
The flows through 2021 were all passive,
Okay.
active to passive. I haven't seen the flows for 2022. Have you seen them?
I have not, other than just the conversation is less on the, say, the defined benefit, the active sort of decision-making process by a board. It's the automated 401k deposits. Far more 401k contributions are going into target date funds than they ever have been, and a growing share of the underlying funds within the target date are passive.
Yes.
And so there's a natural build in that direction, aside from boards making decisions, I want to be active, I want to be passive. It just sort of by default, more flow is automatically going that way.
Right. And it's interesting because on the DB side, when you think about it and you think about the active to passive, as you know, the passive manager loses in down markets on average. And so you've had a heck of a bull run for a long period of time. And as you know, unfortunately, DB plans tend to be always behind, right? They react after the fact. And so I think that you will find that, you know, last year that was the blip. You saw the rise of the median manager last year. Now, of course, it's back down this year. But if you get that red bar, if we have the red bars above 50, if you start having breadth above 50% and it lasts for a year or two, I can assure you that other plans that have gone passive will think about going active. And I even have, you know, an example with one of your clients that we've talked to recently that I met at FPPTA. They're fully passive, but now they're thinking about, okay, it's great. It's been, to be fair, it's been the best place to be the last 10 years. Every time you see that red bar, it's a better place to be.
Will it continue to be?
Will it continue to be? That's right. And I don't think it will. So I hope that helps.
Very much.
Good.
Any other questions?
I had just kind of a general question about the prime product and looking at your product list. I'm greedy, and so
Yeah, Enhanced 50's done better. Is that what you're looking at?
Well, no, I'm looking at the Russell 1000 Growth Index, and I'm wondering, you know, could you do the same type of enhanced indexing to that index as opposed to the Russell 1000?
We certainly could. It's a more concentrated portfolio,
Right.
but we certainly could do that.
I just look at the returns over, you know, a 5 or 10 year period or whatever there, and, you know, they at least for the past, say, 15 years or so, that's outperformed the Russell 1000.
Yes,
And so it would be nice to have an extra 200 or 300 basis points a year,
it would be.
you know.
It would be, right. So let's just look at page, to your point, look at page 35, William. And you're absolutely right. You look at page 35, this is looking at a 3-year roll of the Russell 1000 growth index minus the 1000 value index. You're absolutely right. I look at this and you're absolutely right. For the last 10 years, yes, if you had to do an enhanced index to the growth, you would have done better in absolute. I'm not saying we would have done better relative. I'm not
But
saying
there
that.
are long
but
periods where it doesn't outperform.
there are long periods where it doesn't. So that's, yeah, correct. Which is, frankly, the ironic thing is the last time you really had the long value performance was following a period that was very, very similar. I mean, the late 90s, 2019, 2021, we pointed this out in our write-ups. You've seen our write-ups. They're very similar, not in many dimensions. I'm not saying we're going to get this, but we'd be happy to do it. We are here to serve you. If you want us as a board to do that, we would do that. But
Because I didn't see it in your
no, we don't.
lineup at the moment.
No, because the problem is that, I mean, theoretically, I'd rather have leeway on both the value and growth side
Yeah.
than not have as much leeway. Yes, you can have leeway. You don't have to approach the Russell 1000 Growth Index as a concentrated 14% growth or higher manager. You could say, I want value. I still want value, and we would do that. So I can't say how our value added would have been plus or minus. We would have kept it close. Would have been a lot closer perhaps than a concentrated. Well, we would have been closer than a concentrated. But I'm not sure.
Brown's underperformance and splitting the difference would have been nice, right? You know?
Yes, it would have been. I do worry though, William,
Sure.
that will happen, and I wouldn't want to see.
Yeah.
I mean, we're giving you now, I mean, the way to think of us is we evened it out a little bit for you relative to Brown.
Sure.
And if you know, the interesting thing is that it's hard for I will tell you that when I teach at Wharton, I say, you know, put yourself in Brendan's world where you're a consultant and you have 9 boxes. You have large growth, large blend or large core, large value, mid, small value, small core, small. You look at that. If you point out what is the best performing box within the 9, I can assure you that that is the box that the managers are going to be underperforming the most by. And so it's always the case that they were in the right place, they just couldn't outperform.
Right.
And so, yeah, but yes, if you're going to go to this market, you wouldn't want to do that.
Sure.
But again, if that's something you want, we'd be happy to work with Brendan and change our portfolio to whatever, we can be an enhanced index to that more concentrated index. I just don't know if it's the best call for you
Yeah.
right now.
Sure.
If that's fair.
Yeah.
Well, good. Any other questions? I love those questions, by the way. Thank you. Thank you. For those who've seen me teach at FPPTA, you know I love questions. So,
Great.
anything else?
I think that thank you very much. Safe travels to Jacksonville and back to Philly.
Thank you so much. And I'm sorry I had to bring in my suitcase. You should, but I wasn't going to leave it in the locked car, fortunately. I'm a locked car.
At least you got it open long enough to get it back.
Well, yeah, I had everything out already, so thank you very much. And it was such a pleasure. Enjoy the rest of your summer, everyone.
Great.
Thank you.
All right.
Bye-bye.
Bye-bye.
Good luck.
Thank you. I appreciate it. Thank you.
If you
Bye-bye.
get an Uber, come back.
I will. Thank you.
Next, Brendan. Anyone need a break? I know I didn't.
We always do it.
I need to.
Yeah, give it like a two.
I need to get on whatever he's thinking.
Oh, okay, all right.
You flat wears me out.
I will say across all of the managers that I hear from, what's interesting, I think the 2 most energetic, excitable, whatever is an index guy and a bond guy.
Oh, really?
But you think, I mean, if you're going to look across the spectrum, real estate, small cap, high yield, those would probably be the last 2 areas of the market that you'd expect an energetic presenter. But
He's always amazing to listen to.
Oh, yeah.
He'll answer anything. He has a good answer to it.
Right guy, just wears me out.
Although their finance, I saw something from the finance guy from work, and he was so far out of touch with what's going on right now.
No kidding.
Yeah, and it's like, I was going to ask Jeff about
I
that.
have a bunch of guys from the University of Florida Business School that live at Okeechobee. You know, I mean, frankly, they're the only ones that can afford it. And some of them, I mean, they couldn't get themselves out of a phone booth if they had phone booths, which we don't have anymore, but we really wonder about it.
Well, there's theory and then there's practice, right?
Yeah, I guess so. What do you want to do?
We go.
Which book?
Great, so let's go ahead. Brendan?
Yeah, I just want to make one comment while I still had Twiggs look open, just the unemployment chart that he looked at, which was page 44.
Yeah.
We've essentially come back to the level that we were just before COVID. But what's interesting is this unemployment rate is after you've subtracted out, 8 or 9 million people out of the workforce.
Yeah.
So if you equalize that for the participation rate, we wouldn't be at this level. But one of the reasons they say we're not in a recession is because unemployment's low.
So is there going to be a yellow bar right here? I mean, that's the question.
Well, there's an argument, if we've already had 2 quarters of negative growth, should there already be a yellow bar?
I think you could make that argument.
Yeah, I mean, I think that's the
I
reality.
guess the reality is, so what?
And who's paying those 8 or 9 million people?
You?
That's the great question, and I mean, something that we talk about internally. How does that, do they all of a sudden raise their hand? And at some point, the unemployment just immediately jumps from 4% to 6%? Or do they stay out forever? Like, how does that resolve
Or
itself?
they're not really out, that they're in the gray economy.
Possibly,
Yeah.
yeah.
Which means they'll stay out in your
Well,
definition.
In the government's definition.
Yeah, in terms of the official numbers, then they would likely stay out.
Mhm.
But yeah, it's just an interesting thing to kind of think through. Again, if one of the reasons you're gonna say we're not in a recession is because of unemployment, yet you've had a number that is statistically very different than it was 5 years ago, how do you use that as the basis when it's changing? Anyway, not to get too far down a rabbit hole, but I thought of that. So I'm gonna go really quick. In the quarterly book, we had our own chart on the Magnificent Seven. We've already talked about it, so I'm not gonna really belabor it other than just kind of slices and dices that information.
Which book? You have 3
You're
here.
gonna pick one in the front.
He's
So
in the big one, the quarter.
And obviously, a lot of information here in the book, but as of the 9-month number, just want to focus on the fiscal year-to-date return. So on page number 18, 26.5%. Versus the page 18 of the big June 30th book.
Because this is fiscal.
Fiscal year 9-month number, 26.48 versus 20 flat for the benchmark, ahead by almost 6.5%. So on absolute terms, fantastic 9-month period. In absolute terms, even better. Now, again, overweight to equity, it's been the best performing area. And just to kind of go down, look, your U.S. equity, collectively, our managers, 28.7 versus 24.5. So collectively, our equity managers are doing better. And we are overweight to the group that's outperforming. International did even better for the, again, staying in that fiscal year column, 30.9 versus 25. So again, absolute fantastic, and again, slightly overweight, because again, we're underweight fixed, underweight real estate. Fixed income, relatively speaking, was positive, but we are underweight, which again was a benefit. Even our manager outperformed for the fiscal year, 4.4 versus 4. We were underweight that in favor of equity, which was up 25 or 30%.
When you say this, on the very top grade line, you say one, that's our ranking within your universe?
Within the total fund universe, correct?
Total fund, plan
Against
universe?
public funds.
And how many public funds in that ballpark? It's a national or a state?
It is national
Okay.
within the, but not every plan reports.
Gotcha, right.
But it's a very good representation. I don't know.
It's okay.
But it's hundreds.
Over 100, over 300.
Yeah, I want to say the number's like
Fair enough.
580, I could be off on
Fair
that.
enough.
And we're the number one,
Correct. 1 percentile,
oh, 1 percentile, okay.
yes. But it wouldn't shock me if you were absolute number 1. Because again, because of the allocation.
Yeah, we're either way on top or way on the bottom.
Yeah.
I mean.
Last year,
Yeah, that's how it works.
last year it was.
Been there, done that.
But the important thing is the long term. I mean, since
Right,
yeah,
inception, we're in the 2%.
Yeah.
And that's going to improve if, equities, in July, that
Two's
might.
fine.
Yeah, 2's not bad. So really, I will kind of leave it there because we've got the July update. We can kind of look at some of the individual managers a little more. Again, I'm happy to spend as much time on this as you'd like me to. But I do think it's just helpful to understand, because within the July flashes and the like, you don't get the universe percentiles and some of those comparisons. So I want to make sure we're at least touching on that. within the quarterly.
Right, thanks.
So then the next book in your stack is the, yes, period ending July 31. And July was great. You did even better. So for the month itself, we were up 4.84 versus the benchmark of 3. And then go over to that fiscal year to date now, 32.1 versus 21.9. Outperforming by over 10%. And again, you're really hitting on all cylinders because it's not, a big part of it is allocation. Again, overweight to equity when equity continues to do well. But again, drop down, our equities did 35 versus the benchmark of 29, US equity. And international did 38 versus 30. So you're getting a lot of relative outperformance on top of the asset allocation impact. So again, just a lot of green. Real estate was down slightly on the fiscal year-to-date basis, 9 basis points behind, but that is the only noticeable negative number. And again, we are underweight that relative to policy. So net to the total was a positive. And if you flip over to page 4, just kind of looking at some of those individual components, Twin, who you just heard from, down slightly for the month, but certainly, at least on a calendar year-to-date basis, is ahead, slightly behind on their fiscal year. Bear Hanley, your value manager, did very nicely for the month, although they are behind for kind of that 6 and 9 month period. But on a fiscal year-to-date basis, slightly ahead, almost 23%.
And how's that variant from page 7?
So page 7 is gross of fees. Page 4 is net of fees. So all the numbers, essentially with the exception of Twin, because they're the same gross and net because you're not paying them, all the numbers that are going to be on 4
Suddenly answer the question.
are lower.
Yeah, because when I'm looking at the numbers for Brown, calendar year to date of 25, they were reporting 23.45. You're reporting either 25.67 or 26, depending on whether it's gross or net.
There's usually some variance in there.
Yeah, I'm not,
Just-
I'm just,
Because they do,
I'm not being critical
a
on it.
median
I just
portfolio
find it
sometimes.
interesting that at the same time, Twin was right on, you and Twin were right on the money.
Sometimes that can be a difference like composite versus account. There can be some variation there. This is obviously your actual portfolio. But then again, the difference between 4 and 7 are the
It's a
fees.
credit to you, but I tend to believe you're not, you know.
Well, all of this information is just taken from your bank statement. So they might aggregate 500 portfolios
They may be
together.
playing some internal games when it gets to their numbers.
Well, I won't say,
I don't
but
know.
in terms of GIPS reporting, if you're showing the composite, it's based on the full average as long as they're compliant portfolios. But there's going to be deviation within from
Yeah,
portfolio.
I didn't mean it in a critical way at all, that was an observation, nothing more.
But then again, as you continue to move down, so I'm still on page number 4, obviously Brown, you just heard from. Very good returns fiscal year to date, over 33%, but behind the index, which was about 36.2%. But then as you go down, I mean, just tremendous outperformance by your small and mid managers. This is really where that performance came from. Look at the fiscal year to date, Pzena 38 versus 19, and DGI 56 versus 27. So obviously we know there can be periods of underperformance from our managers because they're taking active bets, but you're seeing obviously the tremendous benefit on the plus side when they do well, and they do well in a positive environment. And then again, kind of continuing, Silchester 39 versus 36, and Bailey Gifford 36 versus 34. So a lot of relative outperformance on top of just strong results, which has led to really just a fantastic fiscal year-to-date period. August has not been as good. So at least through last week, we were definitely down at least a few percent, although the last couple of days have gotten a little bit better.
Yeah.
So
It's not over, but.
correct. But really, what was such a painful year last year is certainly, so far at least, coming back, and it looks like we'll have a very solid year to put in the books again, knock on wood.
the growth numbers that keep going stronger and stronger, would you, if one of the predictors of inflation would be if people start getting back into value, getting out the growth, even though the high flyers are all there?
Would I expect that to happen? Was that your question? Yes, but probably, how do I say this?
Not a predictor?
After it turns. After you've had
Right.
9 or 12 months of it going the other way, the average Joe, so to speak, investor is like, okay, now I believe it, now I'll go. As opposed to other organizations or other groups that might say, hey, I've seen this trend happening, I'm gonna try to go ahead and
It's
jump
just
and
that
get in front of it.
growth run is so long
Yeah.
that,
Well, and I'm sure I've said this to you, and I know I've said it to plenty of other plans as well. I mean, 2 years ago, 3 years ago, think of a general plan down in South Florida that I've been working with for a really long time. They're virtually all passive with their equity exposure, or were back then. And saying, look, we've been on a tremendous run with large growth exposure. Passive has been doing fantastic. The weights are getting to historic highs. I think now is probably a reasonable time if we're ever going to consider shifting from at least some from passive into active. Now is probably a really good time to do it. Well, here we are 2.5 years later. That was not a good choice. So it doesn't mean that it can't continue, but when you just, and what I try to do is look back over 10, 15, 20 years and look at totality. And if each time it gets to some extreme level, you make some sort of decision like that, it will probably benefit you over the next 10 years. Will it benefit you over the next 18 months or 6 months? Maybe, maybe not. You just don't know. But anytime those large extremes happen, I think it tends to work out, even if you're not getting the exact point.
I think that's called prudence.
Hard to get that perfect point.
Right, right.
In fact, impossible to get it.
Well, and here's the other thing. We don't have to get it right. Our goal is, I would think, isn't to get it right on the timing and all the time. It's to make sure we're getting 8.5%, at or above our assumed rate of return annually. Yes, could we do this and that and get to 11 or 12? Maybe, but you could, if you mess it up, maybe you only get 6. So let's just do what we can to make sure we get our assumed rate, and that's ultimately, at the end of the day, that's the primary goal.
Our chairman can hold his head up high.
The last book we have for you is the REIT discussion. So obviously we've talked about this for the last kind of few meetings, looking at some other closed-end real estate strategies, also incorporated some REIT discussion. William and I, between the last meeting and this meeting, had a bit more of a discussion on really the liquidity aspect of our private investments in real estate. So we're sitting here waiting for money to come back. We've asked for money, but the market's locked up. And so really, the discussion was, could we look at some other public REITs?
When you say the market's locked up, you mean for individual transactions?
Correct. So what most of the managers, all of the managers that I've spoken with are saying, for all practical purposes, no businesses or buildings are being sold, bought or sold.
But they're all rethinking values too.
Right. Well, on top of that, half your buyers from 1.5 years ago are no longer eligible. The banks won't lend to them at these kind of rates.
Right.
So you've had a shrinkage, and then the buyers are looking out there saying, do I want to catch a falling knife? Certainly if it's an office building or other things. So there's just not much happening. So if you're a manager and you've got a redemption queue of $500 million, typically the way you come up with that money is by selling a couple of your properties. It frees up a little cash so you can pay redemptions. Well, if nothing is transacting, it's just not creating that cash flow to be able to pay it out. Since there aren't any transactions, they're collecting rents. Operationally, a lot of these the portfolios are still doing very well. But because there are no transaction activities, they're trying to be very conservative with their cash. If they pay it all out to the redemption requests, and then any kind of thing happens, then they're in a lurch.
So you can't blame them for that.
So they're all being very conservative. So all that to say, the discussion, just generally speaking, was, across real estate, would we want to consider going to a point where maybe it's sort of a hybrid? You have both maybe a public and a private. So at different times, you can either add to or take from your allocation and have more of a liquidity option. I mean, there's certainly benefits and negatives to both sides, both the public and the private. But again, that was sort of the genesis, or the short version of, I think, our conversation, William. Please feel free to add to it whatever you'd like as well. So we brought you just kind of a short book on really three names. One of them is Vanguard, so it's not that active portfolio. But one is DWS, or the division in Deutsche Bank. And then Principal, so our current private manager, but as you may recall from their presentations, they are also very big in all sectors of real estate, including the public markets. So they have somewhat of a similar portfolio, but it's, again, on the public side as opposed to the private side.
Do you have any experience of the private equity real estate converting to REITs? I've never seen it.
I have not heard of that. I mean, I certainly have
It's
asked
kind of
the...
strange, though. You would think that there would,
Yeah.
could be timing that would make sense for it.
Yeah, I don't remember ever seeing that. And I don't know if maybe when you're private, you can do certain things that you can't do once you're a REIT. You have to pay out all your
Including
income.
controlling value.
Yeah.
Well,
Yes.
but in terms of, the rules of how you operate, you have to pay out 90% of your income. You have these filing requirements that you don't have as a private. So as a manager, again, I'm speculating, putting words in their mouth, I would think they like the freedom and flexibility that operating under a private structure would allow versus the REIT structure. But again, that's just speculation on my part. So again, we show the management fees of each of these strategies on page number 1. Number of holdings are listed on page number 2. There's some other numbers in there, but they get a little wonky going through the Morningstar software. So some of that you have to take with a grain of salt. But you can certainly see that GWS Principal, 31 and 41 positions in terms of REITs, but then of course underlying in each of those REITs are numbers of properties. So not to be confused, it's not 31 properties, it's 31 REIT holdings. And then if you kind of get into page 4, just sort of looks stylistically at them, and they tend to be fairly core in terms of how they show out. Relatively consistent, so you don't have one that skews way toward the value side or way toward the growth side. And then performance begins on page 5 and goes into page 6. So what you'll see, obviously, for the last 12 months on page number 5, they've certainly been down, but not down as much as the privates have. But the 2-year number is worse. These are all negative. Privates aren't listed in here, but the privates would be down less over that 2-year period because of, quite frankly, the positive returns they had in fiscal 22. But then you'll notice, again, going out over the longer term, 6 and 7% over the last 10 years. And I think the biggest difference, though, is the volatility. So if you look on page number 6, you can kind of see just the individual calendar years up and down significantly more than you see on the private side. But again, these are all factors that we've talked about. It's based in part on valuation and in part just on kind of public sentiment. REITs trade on the exchange, so if there's really bad news, whether it truly ultimately affects valuation or not, it can be down 1%, 2, 3 in a day, and then back up the next day. Did the value really go up or down? But anyway, the positive side again is the liquidity of these portfolios. I don't know if you want to talk about the kind of the spreadsheet that you put together.
Yeah, and I just, I thought it would be interesting to see what the NAREIT REIT indexes.
It's like a printout of a random generator.
Well, it's on their website. You can go there and they have it going. I only printed back to 20. They've got it going back to 71 for most of the indexes, except for the real estate 50, which wasn't around back then. But so the question that I have is, given that you can't always reliably trade out a principal when you want to, is there a benefit in owning some, some of the assets and REITs that when you decide to get out, maybe not prior to the market going bad, but as the market is turning, can you get a benefit from the liquidity of a REIT by getting out? The one thing I don't really have is a comparison of monthly returns for Principal or, Odyssey or something like that to compare these two. But you can see the monthly returns based on, there are a number of indexes here, but I'm just looking at the All REITs index. And you can see what their monthly returns are. And so the question is, if we had decided, if you didn't get out of Principal back in June of 22, then you were locked in, right? But since June of 22, I think we knew in September that we thought we wanted to get out of real estate, or it would be nice to shift away from real estate. Would there have been a benefit to owning the REIT and being able to get out, whereas with Principal we were not able to? And so that's kind of the gist of why I asked Brendan to do this. Plus, some of the committee members here had shown interest in REITs as well. So, and that was just why we had, and I think, Brendan, you said you were looking at this for some other clients as well. So I thought it was worth having a discussion.
No, it is. So do we, from a management standpoint, do we need the additional liquidity of having, or can we?
No, liquidity is not an issue. We've shifted from doing a once a year withdrawal to doing quarterly, give or take, which, although to me over the long term, I've done cash flow analysis, and if you assume that the plan's going to earn its 9% a year, that actually ends up costing the plan a couple $1 million a year in returns over the long term. But having said that, if you can pick and choose, if you're not just looking at a 9% total return, but if you're trying to pull back to target for certain, within certain managers and asset classes that have outperformed, then hopefully it doesn't have that same negative cash flow impact on the plan or negative return impact. The point is just, it's frustrating to be locked in.
I get it.
Well, that's when Brian.
Particularly frustrated to be locked in and you're seeing your values go down in the private market.
But the real question is there a benefit? So I haven't had a chance to do monthly returns for Principal and see what they look like. But just looking at these REIT returns, and not that they would actually match one of these managers exactly, but they're a good proxy.
I think that for me, the question would be, what's our additional premium we're getting for being illiquid and running the risk every decade or two to be locked down versus the cost of liquidity? So if we're getting a 2 or 3% increase in annual returns by giving up liquidity, I don't know. I think that's a trade-off, and maybe you have an idea about.
I don't really think you get an annual premium by the liquidity. There's really not
So you mean lack of liquidity?
Correct.
Okay.
It's fairly neutiral over
Okay.
time.
All right. Well, then that was.
See, that's
Where you get, and this is the rub from my perspective, and I think a lot of the clients that I work with, which are defined benefit.
Right.
You get rightly or wrongly, you get the performance difference, you get the diversification. And the last 2 years is a perfect example. If you have your real estate exposure in REITs, in 2022, your equities went down 22, your REITs, real estate went down 22, 25, whatever, your fixed income went down 13. Your entire portfolio moved because the REITs, although real estate, the performance correlates to equity. And so from a diversification standpoint, if you need liquidity, if you're funding, and your real estate exposure correlates to your equity portfolio, in a way it doesn't matter, because again, if you need money, whether you're taking it from quote real estate or equity, it's all performing roughly the same. Where privates, for better or worse, they're trading, I say generally 9 to 12 months behind. And so when your public market equity was, and your fixed income was selling off in 22, you were getting the pricing effectively from what happened in '21 on your private portfolio. So it was up 20%. And so from a performance perspective, you know, you were getting a performance smoothing impact from that diversification. Had you been in REITs, you would have been riding up and down the whole way with equity volatility. So again, that's just a performance and a smoothing look at it. That's not really looking at the liquidity conversation, which is why we're really focusing here.
But is that smoothing illusionary? Because they're not marking to market like the public.
See, I think that's the case.
Because I've had some early in my career.
It's lagged. I wouldn't call it illusionary, it's lagged.
It's like,
I mean, it looks nice, because it looks nice on a spreadsheet. I'm saying, but, you know, I'm pretty sure an office building, if they're identical, one's in a public REIT, if it's not marked down 18% in value, I'm pretty sure the similar building, if it were to go to market in the private REIT, would be the same. Now, the question is, if it's truly long-term assets, and we're going to ignore the fluctuations, then that's a separate deal. But I've seen a lot of presentations where these private deals are done, and look how much less volatility we have. I'm like, you're full of shit. You have the same volatility, you're just not reporting it. I mean, I don't.
No, you're
I'm
absolutely right.
No.
Yeah. And again, I think across the board, most plans, when they look at it, they're taking, okay, if I can get 8 to 10% a year, and again, over 30 years, I think the REITs and the privates are going to return the same. If you're getting the same risk profile, okay, you're getting the same performance, they would rather have the smoother ride to dampen the volatility of the rest of the portfolio. I think that's the argument that most have adopted. Not saying it's right or wrong. Does that make sense?
See, but the way I think about it is why is real estate any different than any other asset class? Why aren't there private equity funds in restaurants? And somehow or other you think you're going to get a premium because you've got private management of it or something else. And real estate has survived as sort of an individual investment thing more than other asset classes. Everything else has been securitized, but there's still this backwater of individual investment in real estate. And I just don't see.
With frictional cost, I think it's a lot higher with real estate. You know, trying to sell, if you're trying to trying to get valuation, it's more expensive to try to get valuation. The public markets, for right or for wrong, the public markets misprice publicly traded stocks all the time. But I think it's
and you're going to see the
every
volatility.
property is unique, right?
Right.
So,
Yeah.
you know,
What's unique
with a stock, you're getting a share of a company and every share is equal within its class. But with a REIT, you know, each property in that portfolio is completely unique to some degree.
And then there's the value of volume. I mean, the REITs are just, you know, typically much larger than these private equity.
We weren't looking for a decision today.
Yeah, no,
I wanted to bring it up as an issue because, I mean, it could be a year or more before we are able to get money out of principal. And, you know, by the time you can get it out, you don't want it.
Right.
Yeah.
Because, you know, that's the problem.
That's the plan.
And, you know, liquidity on a quarterly basis is not an issue. There are other asset classes we can take from. I mean, it can be more painful in certain quarters when everything else is down. But it was just a conversation I thought was worth having because I get a little reactionary when I can't access the money that I want to, you know?
But the volatility on 5% of the plan, of the total plan, is how impacting would that be?
In the grand scheme of things, it doesn't have a huge impact, but I'm just speaking in relative terms. And again, I also...
Just ruffles Williams' feathers.
But I can see this, I mean, and we sort of talked about this, you know, and I'm not saying, you know, it's in the next 2 months or 3 months, but maybe at some point down the line, you go to some sort of a hybrid where you have maybe half of your allocation public real estate and half private, and you then have the ability to make some of those decisions like, hey, I'm really in favor of privates right now, we want to reduce the public or vice versa, but it gives you some additional flexibility that the private only doesn't allow.
Or maybe use the time to bring in, as you say, these managers of REITs
Sure.
to get the education on what their perspective is on,
Sure.
on those kinds of things. I mean, we could use the time advantageously.
Yeah, we could certainly bring in
It doesn't cost
a
that.
manager or.
The other advantage, if you have publicly traded REITs, which are typically owned by retail investors, typically there's more behavioral bias, let's say stupidity sometimes. in
More
that
volatility
market.
there?
Well, if there's more volatility and, they're driving prices down 30%, we're like, okay. But, I think there's behavioral timing.
Potentially you get a manager who can, build that into
Yeah.
their.
Agreed, but it's still all, it's a healthy conversation to have, and I appreciate
Well, and
it.
one thing, and again, not that you're trying to get into an arbitrage situation, but if you think back to early 2022, again, if you just look at Williams' printout, January down 7.7, February down 4, back up 6, but then down 3, and then down 4, and then down 7. But in May or June, your privates, you still had access. They hadn't locked up yet. Now, again, not that we're trying to trade back and forth, but it just, it does present at times some
To
flexibility.
get to John's point, I think most of the REITs, also maintain that asset value.
Right.
So they also have their appraisal component. So to the extent there's that sort of behavioral differential, a guy that's in the business of managing portfolios of REITs, I think would be able to advise them as well.
And that,
When the good time is possibly to trade the REITs, in order to provide the liquidity.
If you locked out that option's not there was a problem. That's one of my problems with it. It's like, if you wanted to do something, let's say you want to do something with principal's money right now, you don't know when you're going to get it.
yeah.
And it's true, by the time you get it, you may not want to do anything with it.
Well, and I think there is one other thing too that is a benefit there as well, where, let's say mid-course, you're not trying to leave real estate,
Right.
but you want to adjust your exposure, or the manager wants to adjust exposure. The principal can't just go liquidate half of their office buildings today, their positions. But within the REIT portfolio, you have the ability to move your portfolio overweight, retail, underweight, whatever the case might be. There's a little bit of flexibility there that there's not on the private side.
And what value can you place on the lost opportunity, really is what it comes down to.
And I can send you guys a link to the NAREIT website where I downloaded this. It's, you can pull it up. It's a spreadsheet and you can download it and look at it or whatever. It's good. It's informational. There's a lot of stuff in there about, the more niche focused REITs and things like that as well.
Yeah.
So, for educational purposes, certainly, if there's a manager on that list that you would like to have come, I think that they would come in and do like an educational piece, even if it's
Yeah.
not a formal search, right, maybe?
I would suspect that in our book, yes, picking one out of NAREIT.
Right.
Yeah.
No, not
Yeah.
NAREIT, but yeah.
Certainly.
Farmland is down about 40% this year, it seems like.
In REITs?
Yeah, there's only a couple of them, and they're really taking it down. I don't understand why.
I took over a bankrupt insurance company once, and they had 5 REITs. All 5 REITs were underwater individually. But it didn't make a difference because the Department of Insurance valued them at 0. They were non-admitted assets. So I had these 5 REITs that were upside down. I could easily sell, I could get rid of them, And that benefited me terrifically, because even if I only took 50 cents on the dollar, every dollar that came in was now a dollar that I could count, which before I had 0. Yeah, I love REITs.
Billboard REITs. There's all kinds, and that's why.
But we can continue this discussion
Yeah.
at some
Good,
point.
it's healthy to have. Next, the investment policy, we want to, I think you heard that has to be some of the,
I started to bring House Bill 3, but it's
Oh, no, you don't.
pages. I've read it, but, and you can download it from the Florida Senate website, but.
Start?
Yeah.
So, well, in your existing policy, obviously, you had the Russian and Belarusian item, which now flies in the face of House Bill 3. Have to focus on pecuniary measures by state law. And so in the draft policy, we're including 4 paragraphs that kind of relate directly to the law. So happy to go through those on the individual pages. Sure.
In order to do this,
Yeah.
you need a motion to adopt these, then we can have a discussion on it. Is that how you want to do it?
Well, I think we can talk about it and then do the motion.
Okay.
We don't strictly follow Robert's
All right,
rules.
I was willing to, whatever.
So on page number 4, essentially this is language straight from the law. You have to focus on pecuniary factors. And really where kind of the rubber, meets the road is your proxies have to be voted consistent with the law. Which then, that now is going to fall to the managers when they're voting on your behalf. So that's kind of just the one little aspect. It's the very last sentence.
So my question, how did we police that? That was just go forward.
That's going to be a very good question,
Okay.
and it's kind of to be determined,
Got it.
frankly.
Okay.
As you move on to page number 6, we have a reporting requirement. It's December 15th of each odd numbered year, so it's rapidly approaching this year. We have no idea what that report's going to look like. The Department of Management Services has not issued any rules, any report yet. We're hoping it's relatively simple and straightforward, but it remains to be seen. You'll hear about it once we know what that looks like, but we know we've got the requirement, so it's in the IPS. Page number, sorry, this is the second section of page 4. That goes from 6 and then starts over with the attachment. We've got the removal of the Russian, Belarusian. And then way toward the back, essentially, if you were going to do an RFP for any investment manager services, you're going to follow the law. And any managers that we bring to you are going to be compliant with the law. That's kind of the short version. In reality, outside of the Russian, Belarusian issues, the law's making us focus on what we've always focused on. You haven't been focusing
With the bill, right?
Right. But because it's part of the law, to kind of be technically compliant, that is now effective as of July 1st, we've got these proposed changes to the IPS. Any questions?
I've read the document, given the new law, it makes sense. I'm not a huge fan of ESG screening. That's, it's an ethical issue, a fiduciary issue, in my opinion, but,
Apparently the legislature agreed with you.
Yeah.
I guess. Some local politicians probably not. Having said that, they have to dance to the state. So, I read through it, it makes sense to me. You would like a motion that this advisory committee approves the
That you
proposed-
recommend
Okay.
that staff recommends these changes to the Board of Trustees.
Right.
Um,
So moved.
So, I've notified the city manager and the finance director and city attorney of all of this and let them know that, we'll probably bring an IPS with modifications to the city commission sitting as the Board of Trustees at their second meeting in September. But I have no idea how they're going to react. I mean, right now they're fighting another House bill related to GRU. And, they could choose not to do this, but then they're not going to be in compliance and it'll be another lawsuit that they'll have to deal with. But, staff's recommendation will be that they accept this, and if you make the motion, we can say that it's the committee's recommendation also.
And if I'm available on that date and showing up helps, I'm happy to show up.
I'll send
Anyone else?
those.
Let me ask that
Me
question.
too, yeah.
If we were to bring in alternative aggregators, would we have to do it in conformance with the state procurement laws? Is that what you're saying?
I would argue yes. Now,
I don't think
you're
there's
getting
no
in-
argument. The
That's-
answer is yes.
Yeah.
That's a safe way.
But it's,
to figure it out.
technically
So it'd
speaking.
have to be a public solicitation or something like that?
No, I would,
They know the rules, and they know this is a unique Florida situation, and they know the
Well,
policy.
there are a lot of states that have this, it's just that
and
there are
here's-
some that don't. Some do
of
the
all
other
of the
way.
funds here in Florida, I only know one that's gonna be a problem. And here's, it's gonna get hyper-technical, but in there, it's a mutual fund, in their prospectus, they actually say, we use ESG screening as a part of our process, and we acknowledge that this is gonna lower the returns of the fund.
Oh, right.
Now, did they just wordsmith and jumble it around and say, we use ESG and we think it's going to benefit the returns of the fund? Now you're compliant. but the way they said it, it's not compliant. It doesn't say you can't use ESG as a part of the process. It just can't be the law actually doesn't even say ESG. Social, political, or ideological idea. It has to be risk and return based for the decision. If you say, hey, I'm looking at this car maker that does nothing but electric cars, they're going to make money because of everyone's else interest in battery-powered vehicles and the like, then you're good. But if you just say, I'm going to invest because they're battery and they're green, then you're not.
It's like owning Tesla, right? But you own it for what they call a pecuniary reason, not for your own social or ideological agenda. Which even with the language that we show struck related to Russia and Belarus, if the opening phrase had been for pecuniary reasons, we're not going to do this, then you could probably leave that in there. But I think it makes sense to go ahead and get it out.
Do you think they'll be receptive to
So we have a
this
motion.
proposal with all the lawsuits going on?
I have no idea.
We have a motion.
Yeah, I'll
on the
second.
floor. We have a second. All in favor, please say aye.
Aye.
Okay, very good.
I'll let everyone know when we get the agenda item ready. I think it'll be like September 27th or something, or no, I'm sorry, second Thursday in September. Or no, third Thursday in
Okay,
September,
good.
excuse me.
So,
But I'll let you know.
Mr. Rader?
No, you want to finish your agenda, or? My
No, you
curiosity
got
is, in our total portfolio, what percentage is GRU?
60%.
You mean within
60%? That's
the,
fine, that's,
within
The
the
members.
pension plan?
yes.
So there's different ways to look at it. They are slightly over 50%, I believe, as membership numbers. Their payroll, or actually they're a little bit less than 50% on membership numbers. Their pensionable payroll is about 55% or something. Their pension liability is 65% or closer to something like that. And that's because liability has to do with some retirement behavioral things that the actuary calculates.
Yeah, and can somebody tell me the status of that right now? You alluded to it just about
There's a
5 minutes ago.
lawsuit, the city's challenging the governor's or the legislature's House Bill 1745 or something like that, that mandates that the governor can appoint a board to oversee GRU. So there are two lawsuits. The city has one, and a local citizen group has filed a lawsuit also. We have no idea how it's going to turn out. If the governor
So for the
is,
purposes of this organization, we do nothing until such time as those are resolved?
So there's a
well, I
stay,
mean,
right?
the focus of this group is the investments, right? So that's what I think, you continue to focus on. What can happen at some point, I mean, there's a scenario in which the governor could appoint a board, and for some reason that board could choose to separate GRU out of this pension plan or sell GRU. And so then we'd have to talk to the actuary about splitting those members out of the plan. And, there might be some investment-related impacts that we would discuss at that time, but that's so far in the future and so unknown that we can't do anything with it right now.
Well, you're answering my question, that's fine.
Was GRU previously investor-owned?
No, they were always owned by the city.
It was always owned.
Is there, even, if GRU does become a segregated organization with its own gubernatorial appointed supervisory board, there's no way those funds would stay in this organization, is that correct?
No, they could. I think
Really?
that board could choose to leave
Yeah, as long as
the
it's done.
membership here, and it's just, they could choose to split it out. They could choose to, like going forward, not give their employees a defined benefit plan, force them all into a DC plan.
Close it.
The issue is the existing members are in this plan now, and they're going to have a pension liability associated with that. Plus, there are retirees, GRU retirees that are receiving benefits out of this plan. So those aren't going to go away. There might be a way to split them out and transfer assets to cover some of those liabilities. There's a lot of different ways to split it. They could also sell GRU. I don't think they would do that, but they could, to FPL or Duke, in which case, again, you'd probably be looking at splitting the plan, or a portion of it anyway.
You're answering my question.
That might help. I had a conversation week ago, I won't say who, called me to see if I'd be interested in sitting on this new board. And I talked to some constitutional attorneys who I know, who I trust, and they said, probably likely that the GRU will go to this separate board. And they asked me if I would be interested in sitting on the board.
Yeah, and I've got a friend that I'm trying to help get on that board, should it happen.
Okay, and I basically, because they said, because they knew my background here, the city pension, I said, well, I think that's a conflict of interest, I'm not sure I can do it. I said, but they said, they alluded to the, one thing on the table is possible change in the pension. And I basically said, look, you know, there's a lot of details I don't know. I've looked at people trying to convert DBs to DCs in the past to save a bunch of money. You're going to be sorely disappointed the cost structure of unraveling the plan. I said, happy to have a conversation with you, but it's, you know, I think you guys would be well served to keep the pension plan as is, and I gave a little bit of background of our relative performance relative to other plans. So, but there is conversations going on, and I think it's highly likely politically there'll be a separate board October 1st, despite the lawsuits.
The key difference, I think, John, is that if it goes separate, they're subject to regulation, I think, by the Public Service Commission, or the Florida Public Service Commission.
Right.
I think it's infinitely better for the consumer
Yeah.
than to have it.
I think so as well. So
That is
we'll see
the
what happens.
understatement of the century.
I don't know, we have the same situation over where we are.
Right.
And the city bought it, and it's been downhill since, it really has. Now, some people would say that it hasn't been, but it's, as far as the consumer is concerned.
If they could define benefit.
There's a lot of
Have a
unknowns.
close plan.
But it's used
Have a close
almost as
plan,
a separate taxing authority.
Using the
Yeah.
cash cow here.
Yeah,
Yeah.
same thing.
Yeah.
Well, not anymore.
No, maybe not, but it certainly was.
Very good. All right, there's no public here. We've already had our comments. Any other issues any board member would like to bring up before I conclude the meeting? And then if seeing no hands up, I'd be happy to entertain a motion to conclude our meeting.
So moved.
Do I have a second?
Second.
All right, meeting is concluded. Thank you, everybody.